Imagine waking up tomorrow with no boss, no schedule, and the freedom to trade for a living. Sounds like a dream, right? But here's the harsh reality. 95% of traders who try to go full-time fail within the first year. The market doesn't care about your bills or your dreams. In this video, I'll break down why quitting your job to trade is one of the riskiest moves a beginner can make, and what you should do instead to build real financial freedom. The dream versus the reality. Instagram stories show traders on yachts with laptops. YouTube thumbnails promise easy six-figure months. But the reality looks different. It's 3 a.m. stress-checking global markets. It's canceling plans because your position moved against you. Trading isn't passive income. It's a skill that demands more focus than most office jobs. The fantasy sells you freedom. The reality often feels like a self-created prison. Beginners forget this paradox. Wanting financial freedom means first enduring years of structure. Think about surgeons. No one lets them operate alone after watching a few tutorials. Trading deserves the same respect, yet beginners gamble their life savings after a webinar. Watch what happens when someone rushes in. A software engineer quit his $120,000 job expecting to double his income. 3 months later, he'd lost 60% of his savings on overtrades. The market doesn't care about your resume or your confidence. Without tested skills, you're just another tourist at the casino. Here's why this misperception persists. Trading appears simple: buy low, sell high. But sustaining those wins across thousands of trades, that's a different game. It's like watching a chef make a perfect omelet. Looks easy until you burn your own. The hidden complexity separates spectators from professionals. Recognize the timeline. Top hedge fund traders often train for a decade before managing serious capital. Yet retail traders expect mastery in months because their cousin made bank on meme stocks. That survivor bias blinds people to the thousands who quietly blow accounts. Sustainable trading isn't about catching rockets. It's about controlling risk through boring repetition. Use this analogy. Imagine opening a high-end restaurant because you enjoy cooking at home. You'd need recipes, staffing systems, health inspections. Trading full-time requires that same operational rigor. Just replace food safety with risk management. Both will bankrupt you if you skip fundamentals. The dream isn't fake. It's just deferred. Those yacht photos? They're endpoint trophies, not starting line realities. Professionals trade less than 5% of their net worth because they know volatility's bite. Beginners often risk 50% or more, desperate for quick validation. That mismatch explains why most wash out. Now consider the emotional tax. Trading part-time with play money feels thrilling. Trading rent money. Every tick triggers cortisol spikes. Fear makes you exit winners early. Greed pushes you to average losers. Without financial breathing room, psychology warps every decision. Discipline erodes fastest. A 9-to-5 job forces structure, meetings, deliverables, performance reviews. Trading solo? No one notices if you skip your morning analysis. No HR department cares if revenge trade after a loss. Freedom becomes your enemy when habits haven't hardened into rituals. Here's the reframe. Treat trading like medical residency. Study charts nightly while keeping your day job paycheck. Paper trade until your strategy survives all market moods. Build a track record longer than 6 months of luck. That's how organ transplants and trading accounts stop failing. So why do most rush in? Three reasons. First, they underestimate variance. A hot streak feels like skill when it's just probability. Second, they misjudge drawdowns. Losing 30% requires a 43% gain just to break even. Finally, they overestimate their pain tolerance. Watching 6 months of savings vanish in a week breaks most people. The sobering truth: markets existed before you and will outlast you. Your timeline doesn't dictate opportunities. Missing trades won't bankrupt you, but forcing them will. Real edge comes from patience, not urgency. The income roller coaster. The moment your rent check depends on your next trade, your decision-making changes entirely. You're no longer evaluating setups objectively. You're looking for any opportunity to make money right now. This financial pressure distorts every technical pattern and every risk calculation. When you need the market to provide for you, fear and greed take control. A losing trade isn't just a learning experience. It means you might not make rent. This desperation leads to abandoning stop losses, forcing trades that don't meet your criteria, and chasing losses. Your trading system becomes meaningless when survival instincts kick in. One trader described how he began entering trades without stops when he needed to cover bills. He'd watch bad positions deepen, convinced they'd turn around if he just waited. His discipline disappeared because the alternative seemed worse, accepting that his bank account wouldn't make it through the month. This is how many accounts get blown. Think of trading under financial pressure like gambling with your house keys. When the stakes include your basic stability, you can't make rational decisions. Professionals trade with capital they can afford to lose. That's why they stick to their rules. Your psychology changes completely when every trade means putting dinner on the table. Having separate income creates mental space. When you know the bills are covered, you can focus on proper execution rather than desperation. You take only qualified setups and respect stop losses because your survival doesn't hang on each trade. This detachment is how you actually build skills rather than just scrambling for profits. Many new traders believe going all in will motivate them to succeed. The opposite happens. Pressure forces impulsive decisions that destroy accounts. Without a financial runway, you become a gambler rather than a trader. The market doesn't care about your deadlines or obligations. This is why brokers require proof of income for day trading accounts. They know traders desperate for income take reckless risks. The best way to develop real trading ability is removing this financial stress first. That means keeping steady income until you've proven consistency with disposable capital. Your trading psychology functions differently when responsibility money isn't on the line. Without a paycheck covering essentials, fear dominates. You'll second-guess entries, panic during normal pullbacks, and compound losses trying to recover. These emotional reactions guarantee the outcome you're trying to avoid. Imagine two traders reviewing the same chart setup. One knows his mortgage payment comes regardless of this trade outcome. The other needs this trade to pay upcoming rent. Their decisions won't be the same, even seeing identical technicals. The second trader will rationalize weaker setups because he has to make money now. This pressure creates a vicious cycle. The more you need profits, the worse you trade. The worse you trade, the more desperate you become. Breaking this cycle requires removing the survival element first. Trading small while supported by other income lets you focus solely on skill development. When your emotional state depends on daily trading results, you're set up to fail. Professionals separate their living expenses from trading capital. Amateurs mix them because they see trading as an escape from work. This emotional burden becomes the biggest obstacle to succeeding. Preserve your mental capital along with your trading account. Trade with money you can lose without life consequences. That psychological freedom lets you focus on what truly matters, executing your strategy properly rather than forcing outcomes. The market provides opportunities, but not on your personal schedule. Having external income transforms your approach. You can wait for high probability setups instead of chasing anything that moves. You take losses in stride as the cost of doing business, not as personal failures. This mindset shift is impossible when survival depends on each trade. Your trading edge comes from calm execution, not desperate gambling. Discipline dies first. Here's the script section for Discipline Dies First. The freedom of full-time trading comes with a hidden cost. Without a boss or schedule, most beginners quickly lose their discipline. You might think you'll trade more seriously when it's your only income, but the opposite usually happens. Jobs force structure, set hours, deadlines, accountability. Trading doesn't. One former office worker admitted his routine collapsed within weeks of going full-time. He slept late, skipped market prep, and took impulsive trades. The discipline he had at work vanished without external pressure. Trading demands more self-control than most careers. You decide when to work, when to stop, when to follow rules. It's easy to slack off when no one's watching. The market doesn't care if you show up unprepared. Unlike a job, there's no HR department to warn you about poor performance, just a dwindling account balance. Imagine driving a car with no brakes. That's trading without discipline. You might accelerate when you should stop, ignore warning signs, and crash. Markets don't reward talent. They reward consistency. And consistency requires systems you stick to even when no one's checking. The solution? Keep your job while building trading discipline gradually. Treat trading like a part-time apprenticeship. Set specific hours for analysis. Track your trades like assignments, and review performance weekly. Use work routines to practice structure before risking your livelihood. Discipline grows in steps, not overnight. Most professionals spent years with guardrails before going solo. They proved they could follow a process when the stakes were low. If you can't stick to rules with a safety net, you'll struggle when rent depends on it. Now let's talk about the most painful consequence of rushing into full-time trading: the slow drain of your capital with no backup plan. Capital erosion. The market doesn't care about your account size. Every losing trade takes a piece of your capital, and those small cuts add up faster than beginners realize. Most traders focus on potential gains but ignore how quickly losses compound. You might start with $10,000, but a few bad trades at 2% risk each can wipe out a meaningful chunk before you even notice. Beginners rarely budget for their education. They assume they can learn while trading live, but the cost of those lessons is steep. Think of it like paying tuition, except instead of writing checks to a school, you're paying the market through losses. Most traders lose between 20% to 50% of their starting capital during the learning phase. That's money you can't get back once it's gone. The tension comes from a simple truth. Your trading capital is finite. Unlike a job where you get another paycheck next month, blown trading accounts don't refill themselves. One study of retail traders found that the average person goes through 2 to 3 full account blowups before achieving consistent profits. That's years of savings potentially gone before the real learning even begins. Here's the analogy that sticks. Trading capital is like oxygen in a scuba tank. You have a limited supply, and once it's depleted, your dive, or trading career, ends abruptly. Beginners often burn through their oxygen in the first few meters, never reaching the deeper waters where the real opportunities lie. The moment you're out of capital, you're out of the game, forced back to square one. The solution is counterintuitive, but effective. Trade smaller than you think you should. If you're risking 1% per trade instead of 5%, your learning phase costs 5 times less. That extends your runway dramatically. A $10,000 account risking 1% per trade can withstand 100 losing trades in a row before busting. Plenty of time to refine your strategy. This isn't about moving slower. It's about lasting longer. The traders who succeed treat capital preservation as their first priority, not an afterthought. They know that keeping their account intact means keeping their dreams of full-time trading alive. The longer you can stay in the game, the more market cycles you'll see, and the faster you'll learn. So, why do 95% of traders fail this test? Because human nature works against us. We overestimate our skill and underestimate variance. We confuse luck for competence after a few winning trades. And most dangerously, we scale up too fast after small successes, only to give back those gains plus more when volatility strikes. The fix is mechanical. Set your risk per trade so low it feels boring. That discipline alone puts you ahead of most beginners. Your future self will thank you when you still have capital left to trade after your first real market crisis hits. Because the market doesn't just test your strategy, it tests your ability to protect your stake in the game. That's why capital erosion is the silent killer of trading careers. It happens slowly, then all at once. The traders who last aren't the ones with the best entries. They're the ones who manage exits from losing positions before the damage becomes fatal. So, why does this keep happening to nearly every new trader? The answer lies in 3 psychological traps we'll unpack next. The 95% failure rate. Explained, the market isn't rigged against you, but most traders rig the game against themselves without realizing it. 3 critical errors explain why 95% fail, especially when they jump into full-time trading too soon. These aren't complex market mysteries. They're basic human behaviors that compound disastrously when real money is at stake. Mistake 1. Underestimating drawdowns. Beginners focus on potential gains but ignore how losses snowball. Losing 20% of your account requires a 25% gain just to break even. Lose 50%, and you need 100% returns to recover. Full-time traders facing bills often take desperate risks to claw back losses, accelerating the drain. A trading coach's journal revealed most blown accounts started with small losses that spiraled when traders doubled down instead of stepping back. The second error is worse, confusing randomness for skill. Early wins trick traders into believing they've cracked the code. But markets cycle between easy and brutal conditions. The trader who profits during a strong bull market often gets obliterated when volatility spikes. Without years of data across all environments, you can't distinguish luck from edge. Going full-time after a hot streak is like betting your life savings on black after 3 lucky roulette spins. Last is the discipline gap. Inconsistent routines kill more accounts than bad strategies. A study of trading journals showed most failures came from abandoning plans, not flawed plans themselves. Overtrading, revenge trading, and skipping risk management all accelerate when trading is your sole income. The pressure to produce forces deviations that erode any statistical edge you might have had. These mistakes feed each other. A beginner sees early wins. Mistake 2. Risks too much. Mistake 1. Then panics when losses hit. Mistake 3. Full-time trading pours gasoline on this cycle because the stakes feel existential. Every losing trade doesn't just dent your capital. It threatens your entire livelihood. That pressure cooker environment magnifies human biases that professionals spend years learning to control. Think of this like marathon training. Casual runners don't sign up for a marathon their first week. They build mileage gradually. Yet new traders routinely risk everything before proving they can handle market volatility. The difference? A novice runner feels physical pain immediately if they overexert. Trading's feedback is delayed. You might feel like a genius right before catastrophe hits. Here's what the 5% do differently. They treat trading like a laboratory, not a casino. They track every trade to distinguish skill from randomness. They keep risk small until results prove consistency. Most importantly, they maintain financial stability outside markets until their edge is undeniable. This removes the desperation that distorts decision-making. You spot these survivors by their boring routines. They follow checklists like pilots pre-flighting planes. Their trading size stays small relative to capital. They walk away after hitting daily loss limits. None of this is glamorous, but it's how they survive while others blow up. The irony? Going full-time too soon actually slows your progress. Without stable income, you can't afford the patience required to develop real skill. You'll overtrade to generate cash flow, ignoring proper risk management. The traders who reach professional levels fastest often keep day jobs the longest. Their safety net lets them focus on learning rather than scrambling for profits. So, here's the crucial reframe. Full-time trading should be your graduation, not your starting point. The market isn't going anywhere. Your opportunity isn't perishable. What's urgent isn't quitting your job. It's protecting your capital long enough to develop competence. That smarter path forward? It starts with recognizing these traps before they drain your account. Keep trading small alongside stable income. Prove you can follow rules when nothing's forcing you to. Let consistency, not desperation, dictate when you make the leap. The market will still be there when you're truly ready. The part-time advantage. Here's the paradox of successful trading. The more you need the money, the worse you'll perform. Keeping a steady job while learning acts as your financial safety net, removing the desperation that destroys most beginners. Think of your paycheck as funding your trading education. You wouldn't expect to perform heart surgery straight out of med school. Yet many treat trading as if skills materialize through wishful thinking alone. One trader I spoke with took 3 years to become consistently profitable. During that time, his engineering salary paid for living expenses, while market losses stayed within his predetermined risk limits. Without the pressure to generate income, he could focus purely on refining his edge. This separation between necessity and practice is crucial. When survival depends on each trade, you'll overtrade, ignore stops, and chase losses, the exact behaviors that destroy accounts. Part-time trading functions like training wheels. You get to fall at lower speeds while building the muscle memory needed for bigger moves later. The trader who masters execution with small positions during evenings and weekends develops better habits than the one risking rent money daily. Your job provides runway, the months or years required to transition from statistical loser to statistical winner without catastrophic drawdowns. Some argue that going all in proves commitment, but urgency often leads to recklessness, not results. Trading well requires clinical detachment from monetary outcomes, which is impossible when grocery money is on the line. Those who dismiss part-time trading as half-hearted fail to grasp that discipline thrives under conditions of optionality. You trade better when you can walk away. Here's how the numbers work. If your strategy wins 55% of trades with a 1-to-2 risk-reward ratio, you still face streaks of 5+ losses regularly. The probability math only works over hundreds of trades, far more than any beginner should execute under financial duress. Having alternative income lets you endure these inevitable downswings without psychological collapse. Structure your approach around protected learning. Dedicate fixed hours outside work to studying price action and journaling trades. Treat this period like a paid apprenticeship, where losses are tuition, not disasters. Escalate position sizes only after proving profitability across multiple market cycles at smaller stakes. The market doesn't care how badly you need success. It only responds to consistency. Your job buys the time to develop that consistency deliberately rather than desperately. By uncoupling trading performance from survival, you create the mental space needed to make decisions based on strategy rather than fear. That's when real skill begins compounding. Now, let's examine the milestones that signal you're ready to increase trading time. The transition timeline. Here's the truth. Going full-time should be a promotion you earn through performance, not a gamble you take out of desperation. Most traders get this backwards. They see full-time trading as the starting line when it should be the finish line of a proven process. Think of it like launching a startup. You wouldn't quit your job to build a business before proving you can make consistent sales first. A realistic transition timeline follows 3 clear phases. Phase 1 is the survival stage, at least 12 months, where you focus solely on not losing money. Your job isn't to make profits yet, but to prove you can trade without blowing up your account. Most skip this entirely and jump straight to risking real income. Phase 2 is the consistency stage, another 12 to 18 months, where you track every trade across all market conditions. Your goal here isn't huge returns, but showing you can maintain steady results, whether markets are crashing or rallying. Phase 3 is the scaling stage. Only after 2 to 3 years of proven metrics do you consider replacing your income. Even then, smart traders keep 6 months of living expenses separate from trading capital. One professional I mentored followed this exact path, working construction while building his track record. It took him 38 months before he felt comfortable going full-time. Now, he trades with other people's money at a prop firm. The market doesn't care about your bills or timeline. This process can't be rushed because it takes hundreds of trades to separate skill from luck. A profitable month means nothing. Even a profitable quarter could be randomness. You need multiple years of data showing your edge holds across every market environment. Bull markets, bear markets, sideways chop. Anything less is just guessing. Treat your trading like a side business that needs to demonstrate profitability before getting funding. Start with an amount you can afford to lose completely. What you'd spend on education or equipment in any other profession. Document every trade religiously. Measure your win rate, risk-reward, and drawdowns with the discipline of an auditor. When your spreadsheets show 3 straight years of consistent results, that's your invitation to go full-time, not before. The transition happens naturally when your trading income reliably exceeds your job income for multiple cycles. Not on paper projections, but actual deposited profits. This removes the desperation that destroys most traders. You'll know you're ready when leaving your job feels like a formality rather than a risk. Until then, keep the safety net. Your job provides 3 critical advantages while you build skills: psychological freedom from trade dependency, capital preservation for when you do go full-time, and most importantly, time. The market isn't going anywhere. Those who rush become statistics. Those who prepare get to stay. Measure your progress in years, not months. The timeline isn't arbitrary. It's how long it takes for probability to separate itself from randomness in your results. The profitability checklist. Here's how you know you're truly ready to trade full-time. The market doesn't care about your confidence or enthusiasm. It only responds to results. Professional trading firms use concrete benchmarks to evaluate traders because hope and gut feelings don't pay the bills. First, you need consistent profitability across all market conditions. 3 straight profitable months might feel like success, but it's meaningless if you can't replicate those results when trends change. A prop firm manager once shared that they require at least 6 months of verified returns, with profits in both trending and ranging markets. Anything less is just statistical noise. Second comes position sizing discipline. Can you keep individual losses below 2% of your capital? More importantly, do you have the records to prove it? Most beginners lie to themselves about their risk control until a single bad trade wipes out weeks of gains. Your trading journal should show hard evidence that risk management isn't just something you think about. It's behavior etched into every decision. Third is psychological consistency. Are you executing your strategy even when you're tired, distracted, or on a losing streak? Professionals don't trade differently because they had an argument with their spouse or saw a scary headline. One funded trader described passing his evaluation by treating every session like a shift at work. Same focus, same rules, no matter what. Fourth is scalability. That 5% return looks great on a $5,000 account, but can your strategy handle 10 times that size without crumbling? Slippage and liquidity become real problems when you move from simulator to live markets. If you can't explain exactly how your edge holds up with larger positions, you're not ready for prime time. Finally, you need crisis management skills. Every full-time trader eventually faces a nightmare scenario, a flash crash, broker outage, or personal emergency during market hours. Have you stress-tested your ability to handle these situations without panicking? Like a pilot running emergency drills, you need prepared responses for when things go wrong. Trading without these 5 fundamentals is like opening a restaurant with no food inventory. You might fool customers for a day or two, but the business will collapse once reality checks in. The market exposes unprepared traders faster than any other profession because there's nowhere to hide when the numbers don't add up. Use this checklist as your reality filter. Print it out and score yourself honestly on each point. If you can't confidently check every box, that's not failure. It's valuable information. The difference between gambling and professional trading isn't luck. It's meeting objective standards before risking your livelihood. The safety net strategy. You wouldn't jump out of a plane without checking your parachute, but many traders risk everything with no financial safety net. The smartest traders treat capital preservation like oxygen. You only realize its value when you're running out. Before even thinking about full-time trading, you need 3 layers of financial protection. First, build an emergency fund covering at least 6 months of living expenses. This isn't trading capital. It's your runway when markets turn against you. A trader who didn't do this described how a 3-month losing streak nearly cost him his apartment. With savings untouched, those same losses would have just been temporary setbacks rather than existential threats. Your emergency fund turns market turbulence from a crisis into an inconvenience. Second, maintain separate trading accounts for different strategies. Keep your core account for proven systems and experimental funds for testing new ideas. When one London-based trader mixed these up, he accidentally risked his house payment on an untested strategy. Divide your capital like a chef organizes ingredients. One mistake shouldn't ruin the whole kitchen. Third, establish diversified income streams beyond trading. Whether it's rental income, freelancing, or a part-time job, alternative cash flow prevents desperation trades. One profitable trader still teaches weekend seminars, not just for income, but for psychological stability. Knowing other money is coming in helps him stick to his trading rules during drawdowns. These safeguards achieve 2 critical goals. They remove the do-or-die pressure from every trade, and they give you time to recover from mistakes. Trading without them is like tightrope walking without a net. One slip becomes catastrophic rather than just a learning experience. The best traders treat risk management as a system, not an afterthought. Your emergency fund is the foundation. Account separation provides structure, and diversified income acts as reinforcement. Together, they create enough stability to weather the inevitable storms. Many traders discover these protections too late, after they've already faced margin calls or tax problems that could have been avoided. Implementation matters more than intention. Start small. Even 1 month's expenses saved is better than nothing. Automate transfers to your emergency fund. Schedule regular reviews of your account structures. These habits build slowly, but compound, over time, into unshakable financial security. The market doesn't care about your rent payment or grocery bill. That's why you must create your own safety systems independent of trading performance. Ironically, the more financially secure you are outside trading, the better your trading decisions become. Pressure to produce immediate income leads to forced trades, while security allows patience for the right opportunities. These precautions won't make headlines like big trading wins, but they determine who survives long enough to succeed. The traders who last decades aren't necessarily the most talented. They're the ones who planned for worst-case scenarios. Your safety net doesn't just protect your money, it protects your mindset when you need clarity most. The accelerated learning plan. Watching charts for hours won't make you a better trader. The difference between professionals and beginners isn't screen time. It's how they use that time. Most traders waste years staring at price action without structure, repeating the same mistakes. Here's how to turn practice into progress. Start with deliberate practice. Instead of randomly entering trades, focus on mastering one setup at a time. Break it down into components: entry criteria, risk management, exit rules. Paper trade that single pattern 50 times before moving to the next. The goal isn't profits, it's consistency in execution. A basketball player doesn't learn by shooting from a different spot every attempt. Keep a trading journal like a scientist. Record every trade, but include more than just profit and loss. Note your emotional state, the quality of your execution, and whether you followed your plan. Review weekly to spot patterns in your mistakes. A surgeon doesn't improve by simply operating more. They study their successes and failures in detail. Use video replays of market action. Instead of trading live markets during lunch breaks, watch recorded sessions with your strategy criteria in hand. Pause at key moments and decide whether you'd enter or exit. This removes pressure while sharpening your pattern recognition. Pilots train in simulators before flying real planes for good reason. Allocate time for market study, separate from trading. 1 hour studying order flow dynamics or reviewing historical chart patterns is worth 3 hours of impulsive screen watching. Schedule these sessions like gym workouts, regular, timed, and with specific goals. A musician practicing scales deliberately for 30 minutes improves faster than one noodling aimlessly for hours. The key is quality repetition, not marathon sessions. 30 minutes of focused, rule-based practice after work will outperform entire weekends of undisciplined trading. Track metrics like adherence to your rules, not just profitability. You're building neural pathways. That requires precision, not volume. Now you'll start seeing the same charts differently. Instead of hunting for trades, you'll spot missed opportunities in your journal. Instead of regretting losses, you'll identify psychological leaks. This structured approach compresses years of trial and error into months. But there's one obstacle that derails even the best plans: the identity trap. Calling yourself a full-time trader before earning the title is like printing business cards for a restaurant that hasn't opened yet. Labels create expectations, both from others and yourself, that can warp your decision-making. The moment you adopt the identity, you feel pressure to perform like a pro, often before you have the skills to back it up. Psychologists call this premature identity commitment. It's why so many traders take reckless risks early on. They're trying to live up to a role they haven't grown into yet. You see this when beginners start referring to themselves as traders publicly, posting trades online, or even quitting jobs after a few good weeks. The identity races ahead of actual competence, creating a dangerous gap. Think of it like claiming to be a chef when you've only mastered scrambled eggs. You might convince others briefly, but the reality becomes painfully obvious when you're asked to cater an event. Trading works the same way. The market doesn't care about your self-image. It only responds to your execution. Professionals earned their titles through years of verified results, not self-declaration. This trap is especially dangerous because it warps your improvement process. When you identify as a trader too soon, losses hit differently. Instead of seeing them as learning opportunities, they feel like personal failures. That emotional charge leads to hiding mistakes rather than studying them. One trader admitted skipping journal entries on bad days because it conflicted with the image he'd built online. The market exposes identities ruthlessly. That trader who posts winning trades exclusively. Eventually, their track record catches up. The one who talks about playing the game like a pro. Their account statements tell the real story. Identities based on fantasies crumble under real-world pressure. Skill-based identities grow gradually through measurable progress. Here's the shift that helps. Stop asking, "Am I a trader yet?" Start asking, "What's the next skill I need?" Focus on verbs, not nouns. Instead of being a trader, focus on trading well. That subtle difference removes the performance pressure and keeps attention where it belongs, on incremental improvement. Consider apprenticeships in other fields. Electricians spend years as helpers before claiming mastery. Doctors train as residents long after earning degrees. Trading is no different. Early wins might feel validating, but they're rarely indicative of sustainable skill. The market doesn't offer shortcuts, only the illusion of them. Your ego will fight this. It wants the status now, not after the work. That's why so many traders jump into full-time before they're ready. They crave the identity more than the actual competence. But durable confidence comes from proving something to yourself over time, not declaring it prematurely. The solution lies in delayed labeling. Let your results define you, not your aspirations. If you're profitable for 2 straight years, across all market conditions, the title will come naturally. Until then, embrace being a perpetual student. The traders who last understand that mastery is a lifelong journey, not a destination you announce. This mindset shift changes everything. You stop forcing trades to validate your identity. You become more objective about mistakes. You measure progress in concrete skills rather than abstract status. Most importantly, you avoid the emotional traps that come with defending a fragile self-image. Now consider how this applies to your daily routine. Are you studying charts to learn or to confirm you belong? Are you journaling to improve or to prove you're competent? Honest answers reveal whether identity is helping or hindering your growth. The market rewards skill, not self-perception. Adopting the student mindset gives you permission to focus on what matters. Execution quality over ego gratification. Professionals care more about their edge than their image. They know titles follow competence, not the other way around. Your trading will improve when you stop trying to be something and start focusing on doing the work. What matters isn't what you call yourself. It's what your trading account shows over hundreds of trades. Let those results speak for you when the time is right. Until then, embrace the freedom that comes with being a dedicated learner. The market doesn't care about labels, only performance. This brings us to the mindset that separates temporary winners from lasting professionals. Instead of fixating on profits, they focus on something far more powerful: the process over profits mindset. Here's why. Focusing on daily profits will ruin your trading career. Professionals measure success by execution quality, not account balance. The moment you start worrying about making money today, you stop following your system. A hedge fund manager once explained their evaluation process. They don't judge traders by monthly returns. They track adherence to strategy, risk management, and decision quality. Profits follow consistently good execution, not the other way around. This mindset separates winners from gamblers. Full-time trading amplifies the temptation for instant results. Bills create pressure to make something happen now. That desperation leads to forcing trades, ignoring stops, and chasing losses. Your system becomes meaningless when you're focused on daily income targets. Traders who last understand profits are byproducts, not goals. Think of a basketball player obsessing over points per game while neglecting fundamentals. They might score occasionally, but their inconsistent form guarantees long-term failure. Trading works the same way. Chasing profits without perfecting your process is like shooting jumpers with bad mechanics. Some will go in, but you'll never shoot reliably. Process-oriented traders track different metrics. They journal whether they took every setup correctly, not just whether it won. They measure consistency in position sizing and risk management. Their focus stays on controllable actions rather than unpredictable outcomes. Over hundreds of trades, this discipline creates statistical edges that casual traders never develop. The market doesn't reward intention, it responds to execution. Your strategy might be brilliant on paper, but profits only come from applying it correctly every time. That requires detachment from short-term results. One professional described treating each trade like a laboratory experiment. The outcome matters less than following the protocol perfectly. This mindset solves the emotional roller coaster. When losses happen, and they will, you evaluate them differently. Instead of feeling like failures, they become data points about your system's effectiveness. You stop taking losses personally because your identity isn't tied to daily performance. The goal shifts from being right to being consistent. Consider how pilots train. They don't judge flights by whether they landed early. They evaluate adherence to checklists and procedures. Trading demands the same operational discipline. Your edge comes from repeating high-probability actions mechanically, not from heroic saves or lucky guesses. The paradox is that profits come fastest when you stop chasing them. By focusing solely on executing your plan, you avoid the mistakes that drain most accounts. Overtrading decreases. Emotion-driven decisions vanish. You start seeing markets as probability distributions, rather than treasure chests. Implementing this requires brutal honesty. Start grading your trades not by profit/loss, but by execution quality. Use a simple scale. Did you follow every rule perfectly? Half the traders who try this realize they're breaking rules constantly without realizing it. That awareness alone improves performance dramatically. Your trading journal becomes the key tool. Instead of just recording entries and exits, document your decision-making process for each trade. Were you bored, scared, overconfident? These qualitative notes reveal psychological leaks that numbers alone can't show. Professionals review journals weekly to spot behavioral patterns. The market tests your process endlessly. Volatile days expose whether you truly trust your system. Most traders fail this test. They adjust strategies based on short-term results rather than statistical validity. Process-focused traders withstand these tests because their confidence comes from methodology, not recent wins. Shifting to this mindset changes everything. You stop checking your account balance constantly. You stop changing strategies after drawdowns. Most importantly, you stop measuring yourself against unrealistic standards. Progress becomes visible in the quality of your decisions, not the randomness of weekly results. Consistency builds gradually through thousands of repetitions. Like a musician practicing scales, the goal isn't to sound perfect today. It's to ingrain proper technique forever. The traders who last decades understand this. Their edge comes from patience and precision, not flashes of brilliance. Now let's examine the specific metrics that reveal whether your process actually works. The real metrics that matter, profit/loss, tells you nothing about your trading skill. The market could hand you random wins while your edge deteriorates. 4 metrics reveal the truth about your performance. Most traders never track them. Win rate alone is meaningless without context. A 70% win rate sounds impressive until you learn each winner gains 0.5%, while losers lose 3%. Calculate your risk-adjusted win rate by dividing winners by total trades after accounting for risk sizes. Professionals care more about this adjusted ratio than raw percentages. Someone winning 50% of trades with 2-to-1 reward to risk outperforms a 70% winner risking twice what they gain. Maximum favorable excursion shows whether you exit winners too early. Track how far each winning trade moved in your favor before closing. If most hits 2R, twice your risk, but you consistently take profit at 1R, your system works, you don't. This exposes the difference between strategy potential and your execution flaws. A trading coach found clients left 40% more profit on the table than they realized by checking this metric. Average loss sensitivity measures your pain threshold. Divide your typical loss by your average risk per trade. If you risk 1% per trade, but average losses hit 1.5%, your moving stops or overruling exits. Consistent 1-to-1 ratios prove discipline even during drawdowns. One journal analysis showed traders breaking rules doubled their average losses during volatile weeks. The market didn't change, their behavior did. Trade duration distribution reveals hidden weaknesses. Group winning and losing trades by how long they lasted. Most discover they hold losers longer than winners, the cardinal sin. Others find certain timeframes sabotage them. A day trader realized 80% of his losses came from trades held overnight, despite his day trading label. Duration metrics expose mismatches between strategy designs and actual habits. These numbers matter more than monthly returns because they're controllable. Profits depend on market whims, but execution quality depends on you. Tracking them transforms vague frustration into specific improvements. That trader holding losers too long can set timers. The one exiting winners early can practice riding trends in simulators. Think of it like a baseball scout evaluating players. RBIs depend on teammates getting on base. Exit velocity and launch angle show pure hitting skill regardless of circumstances. Your trading metrics should similarly isolate your performance from market randomness. Implementing this requires restructuring your journal. Add columns for intended versus actual risk, maximum favorable move, and time held. Review weekly not for ego boosts, but to spot execution leaks. One trader found he broke rules most often between 11 a.m. and noon, his energy slump hour. Another discovered tight stop losses worked better on London session trades than New York's volatility. The market won't give you report cards. You have to grade yourself rigorously. Start with these 4 metrics for 1 month. You'll likely find your biggest leaks exist between your plan and your mouse clicks. That awareness alone accelerates improvement faster than any strategy tweak. Now consider weekly routines. Pick 1 metric each Monday to improve. If last week showed premature exits, this week focuses on letting winners run. Tracking becomes training when paired with specific intent. Over time, these micro adjustments compound into real edges. Most importantly, these metrics keep you honest during drawdowns. Seeing consistent execution metrics proves whether losses stem from bad luck or broken rules. That distinction determines whether you improve strategies or behavior next. The professionals dominating markets aren't necessarily better predictors. They're better measurers. They know which numbers predict long-term success and which are just noise. Your trading future depends less on finding perfect setups and more on perfecting your ability to track what truly matters. This approach works for any strategy. Swing traders discover their best setups occur during specific lunar phases. Scalpers identify their optimal session hours. The common thread isn't the method, it's the meticulous measurement separating random action from intentional improvement. Your next step is simpler than you think. Open your journal right now. Add 4 columns: intended risk versus actual, maximum favorable move, exit reason, and duration. The next 20 trades will reveal more about your real edge than your last 20 months of balance statements. Now let's examine how part-time traders actually accelerate their learning by working around job schedules. The weekend trader. Advantage. Here's why. Forcing day trading around a day job sets you up to fail. Swing trading offers 3 overlooked advantages for part-time traders if you're willing to shift your mindset. First, swing trading aligns with normal work schedules. You analyze charts in the evening, set alerts, and manage positions before or after work. One engineer turned profitable trader spends 30 minutes nightly scanning setups and places orders for the next day. Compare that to day traders sneaking glances at charts during meetings, distracted at work and ineffective in markets. Swing trading eliminates this conflict by operating on a 24 to 48-hour time frame. Second, swing trades often have better risk-reward ratios than scalp trades. 4-hour and daily charts show cleaner trends than the noise of 1-minute ticks. A 3-to-1 reward-to-risk ratio that's rare in day trading becomes achievable when targeting weekly moves. Professionals target these higher probability swings because they don't need to manufacture opportunities every hour. Beginners lose less to spread and slippage when trading fewer, higher conviction positions. Third, swing trading reduces emotional fatigue. Watching charts all day drains focus and leads to overtrading. A teacher who switched to swing trading reported better results after quitting lunchtime trading sessions. By checking positions just twice daily, he avoided knee-jerk reactions to minor fluctuations. The market moves in waves. Capturing the mid-size ones requires less screen time than chasing ripples. The myth persists that more trading equals more profits. But data shows most day traders lose money from excessive activity. Swing traders often achieve better returns with 10 trades per month than day traders make with 200. Time doesn't create edge, patience does. Holding winners for days lets position sizing work while avoiding the friction of constant entries and exits. Think of it like real estate investing. Flipping houses weekly guarantees exhaustion and mistakes. Buying right and holding for months yields better returns with less stress. Trading works the same way. The frequency of trades matters less than their quality. Professionals know markets trend more often than they chop, making swing trading the logical choice for those with limited time. Implementation requires minor adjustments. Shift from minute charts to 4-hour and daily timeframes. Use weekend analysis to identify the week's potential setups. Set price alerts rather than watching live action. One trader keeps his process simple: Sunday night planning, pre-market order placement, and end-of-day reviews. This routine fits seamlessly around his accounting job. The biggest obstacle is psychological. Many beginners resist swing trading because it lacks the adrenaline of day trading. They confuse activity with progress. But trading isn't entertainment. It's a wealth-building tool. The market doesn't care how often you trade, only whether your trades make money. Consider the math. If your strategy wins 55% of trades with 2-to-1 reward risk, executing 20 high-quality swing trades annually outperforms 200 mediocre day trades. Fewer trades mean fewer mistakes, less slippage, and lower stress. Your job becomes finding the best opportunities rather than manufacturing marginal ones. Technical adjustments help. Widen stop losses to account for overnight volatility. Focus on liquid assets to avoid gaps. Track economic calendars to avoid holding through major news events. These tweaks make swing trading more reliable than most beginners assume. The lifestyle benefits compound too. No more missed family events for trading. No more work distractions. One trader described how swing trading gave him back his mornings. He stopped waking up, stressed about pre-market moves. His trading improved when it stopped competing with his career. The market rewards patience more than persistence. Swing trading lets you leverage weekends and evenings without compromising your livelihood. It removes the false urgency that ruins most part-time traders. Your edge grows when you stop trying to force opportunities and start waiting for the right ones. Successful trading isn't about screen time. It's about strategic positioning. Swing trading proves you can work a job and build trading skills simultaneously. The key is choosing methods that fit reality rather than resisting it. Now let's examine how to grow your trading carefully when you do find success. The scaling paradox. The biggest mistake profitable traders make happens when they finally start seeing success. After months of small, consistent gains, they suddenly triple their position size. This is how accounts get blown up overnight. The urge to scale quickly comes from seeing dollar signs rather than percentage returns. But skill development moves slowly, while losses accelerate fast when you trade bigger. There's a trader who made $500 per day on $10,000 capital trading micro lots. After 2 good months, he jumped to standard lots without changing anything else. One bad week erased his entire account. The problem wasn't his strategy, but the speed at which he scaled. Your trading edge works based on probabilities over time, not guaranteed wins on every trade. Position sizing should only increase after proving consistency across market conditions, not because you feel confident. Think of it like a new driver moving from learner's permit to Formula One racing. Just because you've mastered parking doesn't mean you're ready for 200-mile-per-hour turns. Trading larger positions introduces new psychological pressures that test your discipline in ways small trades never did. The market doesn't care how big your dreams are. It exposes emotional weaknesses through larger losses. Here's how to scale safely. First, double your trading size only after 3 consecutive months of profitability at your current level. Second, never risk more than 1% of capital on any single trade, regardless of account growth. Third, when you do increase size, trade the new position for at least 1 month before considering another increase. The paradox is that patience in scaling actually leads to faster long-term growth. Small, consistent winners compound better than occasional big wins, mixed with catastrophic losses. Professional traders spend years gradually increasing their position sizes as their skills and account develop together. There's no shortcut to this process. Track your win rate, risk-reward ratio, and average trade duration across at least 100 trades before increasing size. These metrics will show if your edge holds up across different market cycles. Scaling should be based on statistical proof, not gut feelings about recent success. The market always tests traders who get overconfident. Money management is what separates temporary hot streaks from lasting trading careers. Keeping trades small while learning builds discipline without catastrophic consequences. When you eventually trade larger, the habits formed from hundreds of small trades will protect you from emotional decision-making. Trading is about survival first, growth second. The urge to go big often comes from impatience or envy of others' apparent success. But every trader's journey is different. Focus on what your numbers say, not what peers claim to earn. Scaling properly means waiting until your system proves itself, not when your ego demands validation. The market punishes those who rush. True readiness comes when increasing your position size feels cautious, not exciting. That's when your psychology has finally caught up to your account balance. Most traders never reach this point because they scale too fast and blow up first. The traders who last are the ones who respect how dangerous larger positions become. You'll know you're ready to scale when losses at the new size don't make you second-guess your strategy. If a normal drawdown shakes your confidence, you've gone too big too soon. The comfort comes from experience, not just capital. Trading larger should feel routine, not thrilling. That's the scaling paradox few understand. The prop firm shortcut. Prop firms solve 3 critical problems that stop most traders from going full-time. First, they provide capital without requiring years of savings. Second, they offer structured evaluation processes that mirror professional trading floors. Third, they remove the emotional burden of risking personal funds. Yet most beginners dismiss them as scams without understanding how they work. A funded trader described his experience passing a prop firm evaluation. The strict rules forced him to develop disciplined habits he'd avoided with his own account. The profit targets weren't arbitrary. They proved he could trade consistently under pressure. Trading with their capital meant his rent money stayed safe while he refined his skills. Think of prop firms like commercial kitchens for chefs. Starting your own restaurant requires massive upfront costs and risk. Working in an established kitchen lets you focus on cooking, while others handle equipment, ingredients, and overhead. Trading with prop capital works similarly. You trade their money while they manage infrastructure and risk controls. The key benefit is reduced personal risk. Most evaluations cost less than 1 month's worth of trading losses for the average beginner. Passing means you trade larger capital than you could access alone. Failing provides clear feedback on where your strategy needs work, far cheaper than blowing a personal account. Programs with reset options let you retry without new fees if you follow improvement plans. Prop firms also solve the scaling problem. As a retail trader, growing from $10,000 to $100,000 takes years of compounding. Prop accounts offer six-figure allocations immediately after passing evaluations. The profit splits still leave more absolute dollars than most beginners make trading tiny personal accounts. One trader calculated his prop firm earnings at 5 times his previous personal trading income, even after the split. Evaluations teach professional standards too. The drawdown limits enforce strict risk management. The timeframes discourage gambling behavior. Traders learn to treat capital as a tool rather than lottery tickets. The psychology changes completely when you're accountable to institutional rules rather than personal whims. Consider how professional athletes develop. Nobody joins the NBA without proving themselves in training camps and tryouts first. Prop evaluations serve the same purpose. They separate serious traders from casual gamblers. The passing criteria aren't arbitrary. They demonstrate you can follow rules under realistic conditions. The funding model makes sense mathematically. Prop firms profit from traders who pass and become consistent. Their incentives align with your success, unlike retail brokers who profit from your activity regardless of outcomes. Their risk teams actually want you to follow trading plans because predictability benefits their bottom line. Implementation matters. Choose firms with transparent rules and reputable track records. Read evaluation terms carefully. Some impose unrealistic conditions. Start with the smallest challenge size to test the process before committing larger fees. Many traders fail initially because they treat evaluations like regular trading rather than the structured tests they are. The path becomes clearer once you pass. Most funded accounts offer scaling plans where proven performance unlocks larger allocations. Unlike personal accounts, losses can't wipe you out. You reset and try again. This creates psychological safety nets that help traders develop without existential pressure. Prop trading isn't magic. You still need a working strategy and discipline, but it removes the biggest obstacle, personal financial risk, while accelerating access to meaningful capital. Traders stuck in the small account grind for years often break through quickly with prop backing. The structure forces professional habits that retail trading rarely teaches. The smart approach combines prop opportunities with continued personal trading. Use small personal accounts to test new strategies. Deploy proven methods with prop capital. This diversification reduces reliance on any single income source, a key principle for sustainable trading careers. Your move isn't choosing between personal and prop accounts. It's using both strategically. Build skills with personal funds until you can pass evaluations. Then scale sensibly with prop capital while keeping personal trading as a testing ground. The hybrid approach gives stability while pursuing growth. Now let's examine the mindset that keeps traders grounded through all stages of this journey. Success isn't about radical transformations. It's about incremental improvements guided by reality rather than fantasy. The market rewards those who adapt to its demands rather than demanding it adapt to them. The balanced trader's mindset. The market rewards patience more than passion. The most successful traders I know share 3 fundamental truths that keep them in the game while others burn out. First, trading isn't about getting rich. It's about staying solvent long enough to let compounding work. Second, your worst enemy isn't the market. It's the version of yourself that overtrades to prove something. Third, consistency beats heroics every time. Trading forums and social media push a dangerous narrative. That total commitment means going all in immediately. What they don't show are the thousands who followed that advice and disappeared. A trader with 15 years of experience once told me his key insight. The market doesn't care how badly you need to succeed. In fact, desperation erodes the very discipline you need to win. The professionals who last treat trading like a skilled trade, not a lottery ticket. This is a marathon with occasional sprints. There will be periods where you need to press your advantage, and others where survival is the only goal. The balanced approach resembles a hybrid car's efficiency, not as flashy as a sports car, but far more reliable over the long haul. One hedge fund manager measures success by how boring their weekly performance reports look. Exciting months often mean someone took unnecessary risks. The three practices that sustain longevity are simple but unsexy. First, separate your self-worth from your P&L. Second, maintain physical and mental health routines that have nothing to do with trading. Third, diversify your identity. Have hobbies and relationships that don't involve markets. Traders who make the profession their entire personality tend to make emotional decisions when their strategy needs objectivity. Consider the math of survival. A trader with a 5% edge who risks 1% per trade has a 97% chance of being profitable over 100 trades. But that same trader risking 5% per trade faces a 38% chance of ruin, even with the same edge. The balanced approach preserves your capital for when you finally develop true skill. There's no prize for arriving at profitability with nothing left to trade. Market veterans develop a rhythm to their decision-making that newcomers mistake for instinct. What looks like intuition is actually pattern recognition refined through thousands of observed repetitions. This takes years, not months. The balanced trader accepts this timeline rather than fighting it. They focus on executing their process correctly rather than demanding immediate results. Your action plan starts with setting realistic benchmarks. Measure progress in consistent execution, not percentage gains. Track how often you follow your rules, not just whether trades worked out. Build your trading size only after proving you can survive drawdowns without changing strategy. The market will test your patience, but patience is the test you must pass. The final truth is this: sustainable trading careers aren't built on intensity, but on resilience. The ability to come back after losses, to stick to proven methods when they're boring, to treat trading as a business rather than an identity. These determine success more than any single brilliant trade. What looks like restraint is actually the fastest path to consistent results. Your 3-step action plan. Here's your 3-step action plan to build toward full-time trading the right way. Most traders jump straight to complex strategies, but the real path is simpler than you think. The market rewards consistency over cleverness, and that starts with mastering fundamentals before moving to advanced techniques. First, commit to 6 months of small lot trading with real money. Use micro contracts or fractional shares. The size doesn't matter as much as developing real execution skills. Track every trade in detail, including your emotional state and decision-making process. A trading coach I work with requires all students to log at least 100 small trades before discussing position sizing. This builds pattern recognition without risking meaningful capital. Think of it like training wheels on a bike. You need them until your balance becomes automatic. Second, establish your baseline metrics. Calculate your win rate, risk-reward ratio, and average hold time across at least 50 trades. Most beginners can't recite these numbers, which is like a basketball player not knowing their free throw percentage. Once you have data, focus on improving one metric at a time. If your win rate is 40%, aim for 45% before adjusting anything else. This targeted improvement approach prevents changing too many variables at once. Track progress weekly in a simple spreadsheet. Complex analytics come later. Third, simulate full-time conditions while keeping your job. Dedicate 2 hours before or after work to treat trading like a profession. Set up your workspace, eliminate distractions, and follow your routine exactly as if it were your sole income. A successful trader I mentored did this for 18 months while working construction. He'd wake up at 4:30 a.m. to trade the London session before his shift. This discipline test reveals whether you can handle the structureless nature of full-time trading. Most discover they need more practice managing unstructured time. These steps work because they reverse engineer success. Just like a video game skill tree, you can't unlock advanced abilities without first mastering the basic moves. Every professional trader I've interviewed followed some version of this gradual path. None skipped straight to complex strategies. Your assignment this week: start with step 1, using the smallest position size your broker allows. The market isn't going anywhere, but your capital might if you rush the process. Small, consistent improvements compound faster than you expect when done correctly. Next month, compare your trade logs to today's, and you'll see measurable progress most miss by jumping between strategies. Remember, professionals built their skills the same way you will, one deliberate practice session at a time. The traders who last are those who honored the process when no one was watching. Conclusion: here's the truth. Full-time trading isn't about quitting your job. It's about proving you can replace that income consistently before making the leap. The market will still be there when you're ready. What disappears is the desperation to succeed before you've built real skill. Focus on the process, not the dream. Track your metrics, refine your edge, and let the results dictate your timeline. The traders who last treat this like a profession, not a getaway plan. Your future self will thank you for moving patiently. If this resonated, hit like and subscribe. More truth bombs coming your way. See you next time.